Welcome back to Capital Market Development, China and Asia, our regular webinar series. Today, we're very happy to have Shashwat ALOK from Indian School of Business, and the topic is open banking and the digital payments implications for credit access. Shashwat, please go ahead. What is the time? Bernie, what?
It's sort of like the MBR. We'll aim for 25 and 20 and discussion, or 25, 25 and discussion. And we aim to finish before 11:10. The extra 10 hours just to give people opportunity to, just in case that they want to extend the discussion.
Great.
Thank you.
So Shashwat, you have 25 minutes.
Okay, thank you, Jun. Thank you, Bernie and ABFER and Singhua for inviting me for this presentation, and thanks a lot to Ben for doing this with an unpolished, not a finished draft. So this is joint work with Pulak, GHOSH, who is at IIM Bangalore, Nirupama, who works at CAFRAL, a research unit of the Reserve Bank of India, and Manju, PURI at Duke. Let me start. Get right in with the motivation. So this is in the line of work that I have been trying to pursue to see how technology can enable financial inclusion in India, and does it impact, if it at all, how does it impact end users' welfare? So we know that the world leaders grapple with income, wealth, and consumption inequality, and financial access is one of the powerful tools in which can enable individuals to bridge this gap inequality. But despite the progress that the world has made, about 1.4 billion people around the world still lack bank accounts. So we looked at this large-scale financial inclusion program in India called Jan Dhan Yojana, which aimed to expand access to savings account to most of the Indian population. And what we found is that while access to savings leads to some increase in credit, most of the people who got these bank accounts who were earlier unbanked, they were still not able to access credit, primarily because there is no information on the basis of which banks can judge their creditworthiness. Now, there is already literature which suggests that while credit history may be absent, one could use alternate data to measure the creditworthiness of individuals and potentially expand credit access. Despite this promise of financial technology, the current literature provides or offers limited evidence on whether fintech has really been able to expand access to credit. Our focus in this paper is, can open banking-based public provision of digital payment infrastructure combined with the power of bank accounts help expand access to credit, especially to the marginal borrowers? Now, I'll not get into the details of open banking a lot because I have enough to cover, but open banking is a framework which empowers customers to share their financial data across bank accounts and across financial intermediaries at the press of a button. And obviously, this is all consent driven. Now, 49 countries around the world have adopted some kind of open banking framework, and India in this sphere took a lead by implementing UPI, which we are going to talk about in a little bit of detail, United Payment Interface that enables real-time digital payments in 2016. And this is really an open architecture, meaning we can use UPI to any third-party app or a bank app built on UPI can be used to transfer or make transactions across all bank accounts, which is very different from what used to happen earlier in the earlier regime. Using one bank account's application, you could only make transactions based on the savings in that bank account. Now you can use any bank account's mobile application to transfer or access any other bank accounts. So that is the openness that we are going to focus on. Now the bottom line of all of this is that customers really had the heart of open banking. Any data sharing is consent driven, and the hope is that if you allow such data sharing, it could increase competition in the financial intermediation space. New entrants can possibly, or even old incumbents can possibly leverage this data sharing and real-time financial transaction history enabled by a digital payment system to expand financial access. And hopefully it can lead to more innovation as well. Our focus is going to be on financial inclusion, although I think that we do have some implications for innovation in the credit space. Now, the key players in that are envisioned in any open banking framework are these third-party account aggregators. These are also called account information service providers that enable sharing of data across financial intermediaries. Now, you don't necessarily need account aggregators. You could also leverage open APIs, which is another way to share data across intermediaries. We are going to focus on one form of entity under open banking, which is payment information service providers. The idea again is that such PICs, PISPs can enable consumers to perform payment transactions by accessing all their bank accounts from a unified app. Now, our research question in this paper is going to be, how does open banking based digital payment infrastructure affect credit markets? Does it expand access to credit? If so, for whom? Is it really expanding credit for those who were outside formal markets earlier or those who were underserved? Or is it really expanding credit by making accessing credit more convenient to those who are already included? And then we have the universe of unsecured consumer loans in India. So we'll also be able to comment on whether this facilitation of credit access is happening via incumbent banks or fintech lenders. And we want to have some comments on the distribution of borrowers. So I'll describe the data in a little bit of detail, but we combine unique and proprietary data from 6 different sources. It took us we started this project about 3 years ago. A lot of time was just spent convincing people to share data and putting it together. So, to summarize, because I may not be able to complete all my slides, these are the main results. We first find that this open payment infrastructure powered by bank accounts leads to a broad-based expansion in credit. In particular, in terms of growth, there is a significantly higher increase in credit flow to underserved and marginal borrowers. And this increase in credit flow to underserved and marginal borrowers is primarily led through fintech. In fact, for banks, we see an increase in credit only for prime borrowers, but not so much for the marginal and underserved borrowers. And this increase in credit for the new to credit or the underserved segments is significantly higher in areas that got this Jan Dhan Yojana bank accounts. So these were bank accounts that, this was the program that seek to expand access to savings bank account to the entire population of India, especially covering those who were earlier unbanked. And we also find that because this digital infrastructure requires access to internet, a launch of a new mobile internet provider, which significantly brought down the cost of accessing internet. Those regions which got this access to internet earlier, cheaper internet earlier, credit increase is significantly greater in those regions. And that also serves as an alternate empirical strategy for us. Now, why should an open digital payment infrastructure affect credit? It can affect credit to the extent that an open digital payment infrastructure allows people who were earlier transacting outside the formal financial system, primarily using cash, to now have a digital trail of verifiable financial transactions. So as a bank, I can pull data of a roadside kiosk and figure out what is their monthly revenue, what is their monthly consumption based on their UPI transactions. And the adoption of UPI obviously has a huge role to play. If it was not adopted, then we could not share data. But to the extent that these people who were earlier transacting in cash are now transacting digitally, they are creating this digital financial trail, which can then be used to access credit. Now, on one hand, this open payment infrastructure can break the monopoly of incumbent banks who would earlier have the primary access to your information. If you wanted to take this information and apply for a loan, if you had such information. One problem is that many of the Indians did not even have a financial history. But even if you had to print a statement, take it to another bank account. UPI and this digital infrastructure changed it. Now this can happen at the click of a button, and you can share this information across bank. But on one hand, it allows for more information sharing. On the other hand, by virtue of hurting incumbent banks' profit, it may lower relation-specific investment from incumbent banks, which may have adverse implications for credit supply. Now, you bring in this open banking induced competition. On one hand, it may hurt incumbent banks. On the other hand, it can encourage innovation by new entrants. These new entrants can use this new data to come up with better screening technologies and expand access to credit to the underserved, which is what we find.
Clarification, please.
Yes, yes.
This openness include what items? Just the financial history?
So the openness envisioned is broader, but we are going to focus only on transaction history.
So it's only transaction history because the bank has more information than just the transaction history.
Yes, so
Statement and transaction.
I agree. And the broader account aggregator framework under open banking in India envisions gathering all sorts of data, including your tax filing, e-commerce transactions. Not all of that is implemented yet. In this paper, we are primarily focusing on individuals who are operating earlier outside the banking system, or even if they were part of the banking system, they did not have much financial history. There was not much data available for them. So we are focusing on this narrow part of broader data framework, which is payment transaction.
Your time. Just more clarification. So
Yeah.
I have only access to your bank statement. That's it.
Bank statements, or you can directly access my UPI transactions.
Yeah, right. Got it. Thank you.
So in terms of marginal contribution vis-a-vis the literature, this is the first large sample study to examine the impact of open banking in the form of publicly funded digital payment infrastructure on credit markets. Because we have the universe of all consumer loans, we can study these effects across institutions and across borrowers. And what we find is that savings account by itself was not enough to expand access to credit, but savings account coupled with this digital payment adoption and the sharing allowing the sharing of such digital data has led to increase in credit, particularly to subprime and new to credit borrowers. And this increase in credit to these marginal segments is driven by fintech.
Shashwat, sorry,
Yeah.
More interruption. Sorry about that. Really sorry about that. So I am a bank, you're my customer. I have access because I have the right to access, but I may not know all your information. Do I have your complete financial information in the banking system or just the one you told me?
No, you may not have all the information. So towards the end, if I get time, I'll talk about this sort of like a case study. So we got micro level, low level data from one particular fintech to see what they are doing. So for this, especially for this roadside kiosk or new to credit segment, most of the time, all they have is their UPI transaction history.
Okay.
So many of these loans are enabled based on UPI transaction history. But over time, maybe they are building other kinds of data. So most of these people don't have insurance. Most of these people don't have investments, don't have savings, they don't file taxes. So for those segments, you really don't have any other information. For people like us, they can access everything if they want.
My concern is selective openness.
Yes, so it is, I mean, because it is happening in phases, openness is increasing. For instance, today, if a bank wants to access my tax records, they can. Maybe in a couple of years, they may be able to also access my e-commerce transactions if I provide consent. So this is a gradual process. Initially, it started primarily with digital payments history and other bank account transactions for wherever bank accounts were possible. But I agree with you that in this part, yes, it is yet selective openness, but the framework is broader than just payments. And so we are hoping to do follow up on other aspects of data and how that can impact the end consumer. So why do we focus on India? One, it was one of the earliest countries to implement an open digital payment infrastructure. And a lot of world organizations such as IMF has been claiming that this has led to greater innovation in financial services. This has expanded markets and closed gaps in financial inclusion. But most of these are top headline statements, not really backed by data. And so here is where we think we can help. We bring in a lot of data. to see if this is really happening. Now, what is UPI? It's very similar to any digital wallet that you may have seen. The key difference being that this is powered through bank accounts. So my money has to be in bank account. If I have to, this is primarily to make payment transactions, and it enables me to make payment transactions through a common platform across banks. So if I have 3 bank accounts, I go to one common UPI app. Let's say Google. Google has an app for this, and through the Google app, I can access all my bank accounts. So you have bank accounts. You have this what is called public rails, which is the routing system to enable the payment flow. And finally, you have payment APIs that different banks and third-party developers like Google can use to create the user interface, which ultimately the user deals with. Underlying that, there is this rails that route payments across banks powered by NPCI. If I have time at the end, I will take you to the flow chart of exactly how it works. I just wanted to show you one thing. So this is how a Google Apps looks like.
Sorry, clarification again.
Yeah.
Your first line in the previous slide, it seems that the full information is automatically onto the UPI. As long as I have a bank account in any bank, all of them are disclosed.
All the transaction information, yes, but it may not have
Okay.
your investments and savings information.
Okay, thank you.
Yes, so all the financial transactions is available through this. That is true. Yes, sorry, I did not understand it. So I just wanted to show you a simple the design of an app, and primarily to show you that now the Google app actually shows you that you can take a loan. You can click a loan, and that information gets relayed to multiple banks, and then they compete to offer you the best terms based on what you needed. Now, the adoption of UPI has been phenomenal. You go to any rural, remote part of India, a small vegetable vendor or a roadside kiosk will display this QR code. And this is a photo of Bill Gates when he came to India. He tried to transact using UPI to buy a tea from a roadside vendor who got famous. The underlying idea is fairly simple. Earlier, people were transacting in cash. They did not even have bank accounts, so there was no verifiable financial history. Now, some of these people start transacting digitally. So now there's digitally verifiable revenue. Banks can directly access this data if the user provides consent, or banks can access this data through these payment apps. The advantage of payment apps is that payment apps are dealing with multiple banks anyway. So if the user provides consent, they can pull this UPI transaction history from multiple banks. And then once I can figure out the some measure of income of these individuals, hopefully I can expand access to credit based on expected cash flows. So UPI is interoperable. The penetration has been quite broad. Now there are quite about 430 million unique UPI accounts in India, and nowadays we average about 10 billion transactions per month in terms of number of transactions, amounting to USD 20 billion. And about 75% of all retail digital transactions in India happen on UPI. So in terms of data, we have credit flow data from at the PIN code level, not at the individual level, from one of the credit registries in India. On top of that, we got UPI transaction data at the PIN code level from one of the top 5 UPI app providers. Then from RBI, we got proprietary data on bank deposits at the PIN code level over time. This is going to be important for us to create the exposure measure, exposure of a region to UPI, which is based on the deposit share of banks, to see if this increase in access to credit is primarily happening in areas where there was this new Jan Dhan Yojana savings bank accounts for the all opened. We received again PIN code level data from the Department of Financial Services, Government of India. And then we combine this with telecom tower data as we use another shock, which was the launch of this new company, which significantly brought down the cost of internet. And finally, we provide some micro level evidence that UPI is really being used by fintech lenders using the setting of a large fintech lender in India who primarily caters to this roadside kiosks.
Shashwat, you have 5 minutes remaining, but Bernie asked a lot of clarifying questions, so I'll give you a few more minutes.
Okay, thank you, thank you. Yeah, so this paper is obviously always challenging uh, to finish within the stipulated time, primarily because explaining UPI ends up taking a lot of time. So these raw trends kind of tell the full story. The blue trend line here is indicating banks. On the y-axis, we have number of loans, not the value of loans, but number of loans given. The first dotted line is 2016, where UPI was initiated. And 2017 is when UPI really became open, because it allowed bank apps and third-party apps like Google to partner with multiple banks. Until then, it was really they could partner with one bank, but in 2017, any app could partner with multiple banks, which really made it open. So, I mean, first we noticed that there is an increase in prime borrowers. That trend was there even before UPI. But if you focus on fintechs start lending to these prime borrowers as well after the launch of UPI. The key action for our purpose is happening in the subprime and new to credit. For banks, we do not see a significant increase in credit year on year for these segments. UPI comes in, and then fintechs, at least in terms of number of customers served, within a span of 3 years, are able to serve the same number of customers in this marginal segment as traditional banks were serving. And these traditional banks have been in existence for a while. So in terms of our identification strategy, this is a macro level shock. So identification is obviously going to be challenging. So we leverage the framework of Amyatosh and Tamanna, who have a recent paper looking at whether cashless transactions can boost economic growth. So what we do is we figure out which banks went live early on UPI. And because we have deposit level, branch level data, we figure out for each pin code what is the deposit share of early adopter banks. And that becomes our measure of UPI exposure. And then we will sort these pin codes into high and low UPI exposures. So the UPI exposure measure is really capturing the deposit share of banks who were early to adopt UPI. And the idea is this is building on recent work by Croce, Gupta, and Mazzanotti, who show that there is network externality in digital adoption. So areas that adopt these this new payment technology earlier, they continue to have persistently higher adoption rate as compared to as compared to other regions. And this persistence difference in UPI adoption is what we are banking on. Now, in the revised draft, which we hope to make public soon, we show that there are this persistent difference across high and low exposure areas. We also compare, so ex post we can't compare, obviously, the counterfactuals, but prior to launch of UPI, we look at nightlight intensity per capita, nightlight growth, which is the only economic activity measured available at the pin code level, credit, and we don't really find much difference between the treatment and control group, the high exposure and low exposure areas. So as a first stage, we see whether our high exposure measure really predicts UPI usage, and we find that there is significant correlation between our exposure measure and UPI usage. UPI transaction is higher by 12.7% relative to the mean in pin codes with higher exposure. Our real interest is in understanding the impact on credit, and here we see that the trends were broadly parallel prior to launch of 2016. Post launch of UPI, there is an upward movement in credit, and this really picks up post 2017 when UPI became more open. And whether we look at fintech or banks, we sort of find very similar effects. So now we are essentially running a difference in differences regression, and I will not go through all the results. This slide is showing you the aggregate effect on overall credit for all unsecured consumer loans across banks and fintech. And we find that there is a 14.7% differential increase in credit value in high exposure areas and 16% increase in the volume and the number of users being served. Now, where is it really happening? So this is based on such DID estimates. Where is this action happening? So if we focus on the first row, which is banks plus fintech, we find a 15% overall increase in the value of credit and 16% increase in number of consumers being served. But the action is really in fintech lenders in terms of growth. fintech lenders experience a 40x growth in the credit supply and 77x growth in terms of the number of customers serving. And this is both for subprime and new to credit. For prime borrowers also there is a growth, but the growth is smaller. For subprime and new to credit segment, there is 100x increase, for instance, in the number of customers being served by fintech players. Quite interestingly for banks, and this also serves as a placebo test, while we find an increase in prime loans and some increase in subprime loans, the effect is far more muted. For new to credit segment, we don't find any increase in bank credit to this segment. Now, one natural concern here is that some of this may be driven by economic-wide activity. Economy drives UPI, economy also drives access to credit. So in all our specification, we are controlling for district time fixed effects. But to go beyond that, what we also do is construct a small 0.4 by 0.4 kilometer grid. This is much smaller than a district, but bigger than a pin code. And we restrict attention to grids which have high and low exposure pin codes, both kinds of pin codes. And then we control for within the smaller region grid time fixed effect. The idea is that we are trying to control for very local economy, time varying economic shocks. And even after controlling for that, we find very similar effects. I am out of time, so I will point out two other results. The first is that, as I mentioned earlier, there were these regions which got higher number of Jan Dhan Yojana accounts open because these regions tended to be underbanked earlier. And so now we run a difference in differences analysis to see if the credit growth is particularly higher in these areas which got this new bank accounts for the unbanked. And that is exactly what we find. Fintech credit to due to credit segment is specifically higher in regions with higher number of JDY accounts. So this triple difference also further helps us claim causality to some extent. And this increase in new to credit is primarily driven by fintech and not by banks. The second thing that we do is this launch of this internet mobile service by Jio, which is a large mobile service provider in India. Launch of Jio was in 2016. By 2020, Jio expanded coverage across India, and it significantly brought down the cost. The data cost in India used to be about $3.5 per GB. It went down to about 10 cents per GB within a short span of 2 years after the launch of Jio. And the idea here is that we want to see areas which got this access to internet earlier. Are these the areas where there is greater expansion of credit because of complementarity between cheap access to internet and the digital payment service, UPI? You cannot use UPI, at least until recently, without 3G or 4G internet. And so we do find that there is some differences in areas that got Jio early versus late. If anything, these differences work against us. So Jio, and we know this anecdotally, this company started entering the low tier 2 and tier 3 cities first. These were cities with lower internet penetrations. So these cities tended to have lower per capita credit growth, lower economic activity. So if anything, the fact that they were entering areas with poor credit access and lower economic activity earlier, this should work against us finding a positive effect. And here we are showing the same thing. So the dependent variable is how long does Jio take to enter a PIN code? And we have these measures of credit access and economic activity at the PIN code level. And we find that the higher was growth of credit or night-like activity ex ante, later is the entry of Jio. So Jio is entering worse areas earlier. And even after we account for credit and economic activity, they only explain 3.3% of the variation in Jio entry, meaning a lot of the, meaning at least a significant aspect of the decision to enter a particular PIN code is orthogonal to credit and economic activity at the local level. And again, just like what we saw earlier, this early versus late Jio areas, there is no differential trend, at least in the pre-period. 2016, we start seeing credit pick up. 2017, there is a significant jump in this credit. And again, we find a significantly higher impact for fintech lenders, particularly for the new to credit segment. Like our baseline strategy, we don't find a significant impact on increase in credit via banks. And I'll skip this. Finally, we got data from one specific fintech lender, and the only reason we are using this, most of our analysis at the level. We want to drill down, are fintech lenders really incorporating UPI measures in their lending decisions? And we find that roadside kiosk level measure of their monthly UPI transactions is significantly or positively correlated with the loan size and the internal credit score assigned by the lender, and negatively correlated with interest rate, suggesting that UPI transaction is being incorporated by the fintech lender. Now we also have some analysis on default.
Shashwat,
Yeah.
maybe time to wrap up.
Yes, I'm done. In terms of default, we don't find any differential increase in overall default rate, suggesting that UPI indeed expanded credit to the underserved but credit-worthy borrowers. To conclude, a large fraction of India are credit underserved or unserved. This is not really an Indian phenomena. This is a global phenomena. We introduced a new channel and examined the impact of public open payment infrastructure on access to credit. And we find that bank accounts coupled with this new payment technology allows for expansion of credit to the underserved. Thank you for your patience, and sorry for going over time.
Thanks. The discussant is Ben CHAROENWONG from INSEAD. Ben, you have 25 minutes until around 11 o'clock.
Okay. Do you see my screen?
Not yet. Hold on.
Okay, let me try it again. No?
Is it my connection, Bernie? Do you see Ben's screen? I don't. I see that he has started sharing.
Here we go. I found them. Yeah, it says my screen sharing is paused, but when I click resume, it doesn't do anything. Okay, I try again.
Oh, no, now, yes.
Yeah. Okay. Now?
I saw it briefly before, but now, is it something to do with your PowerPoint setting?
How about now?
Oh, no, now it works.
Yeah.
Okay.
Okay, go
I
ahead.
forgot about the Zoom settings. Okay, thank you for the opportunity to discuss this very interesting paper. I know Shashwat was a little squeezed on time, so I'll try to expand on some of the, I think, key institutional details that I think are very important to understand the paper. So the main summary, I'm showing you here their figure 1, which is an amazing figure to me. It's written right into the introduction, and it shows the relationship between the UPI transactions and credit, right? And I think very rarely you have a figure 1 that is so compelling and interesting. And that really makes the case for, the importance of this digital payment system on the access to credit. So the paper, I think, is the first large-scale study on the impact of digital payment infrastructure on the credit markets. There's been a lot of focus on this. I think I've read like 10 papers thinking about how does UPI affect consumption, partly because, some of that work is done by Sumit, and so we have to go through it and keep up to date. And then we also find here in this paper that the credit market access increases, it seems, and we have some verifying data from fintech lenders as well as the more aggregate data. And in terms of the relative increases, right, we're talking 20, 100 times increase for the subprime and new to credit consumers. There's a huge data effort. I think the authors go through a fairly large set of robustness tests and jumping through a lot of hoops to try to make the case that, this UPI event really seems to have driven a lot of what we saw in the market in terms of the big economic boom in India. I think it's worth contrasting this with some of the stuff that's found in the US and Europe, and I'll let Manju, who's the expert on this, also maybe make some comments if I say anything that's incorrect. But like in the US, there's a lot of focus on fintech lenders from the perspective of cream skimming, right? And so you have all these fintech lenders actually trying to pull the high quality borrowers away from the banks. So here the focus is much more on the other side of the borrowing distribution, right? Those who are underserved, which of course is where all of the economic development discussion is, and hence the great interest of the IMF and so on, and the World Bank and so on. So it touches deeply on this notion of financial inclusion. It's a little bit related to open banking. I'll try to open it up a bit to see what are the mechanisms at play here. And then there's, of course, the role of government. Okay, so, as an American, I'm also a little concerned, right, that if the government has all my data on spending, it's actually maybe a little bit risky, right? So I'll make some comments there as well in hopes to try to expand on the external validity of some of the findings here. But before I get started, since it's in the title, I think it's worth talking about the open banking framework. And I think there are reasons to believe that the impact of open banking is empirically ambiguous, and therefore theoretically ambiguous, and therefore empirically we want to try to estimate what the net effects are, and that may differ across different markets. Okay, so to just get started, open banking is a financial services model that enables third-party developers to access the data through the use of APIs. That's been the focus in Europe. And Bernie asked a great question. In theory, open banking does not need to be digital, right? Like you could tell your bank to print out a bunch of your statements. You take that physical statement, go to another bank and move your data over there. And so, the role of digital here, I view it as just reducing all of these transaction costs. So I'm drawing on Jigwo's fairly recent JFE, where there's really two effects, and this relates to the way Shashwat presented the framework as well, is that on the one hand, you have lower switching costs, you can move from one bank to another, and therefore the rents that the bank can get is going to be lower. But on the flip side, when you have more open banking, the banks themselves may have less incentive to start new relationships, right? And so you may want to throw into the banking system a bunch of competitors to try to get banks to react. Because if you just allow open banking and you don't have new banks or fintechs coming in, you would expect that the banks may actually cut, right, the creation of new accounts for those without a history, because they don't get that relationship rents that's there from the Rajan Peterson framework, the 97 paper. So it seems to be a trade-off. And of course, the backdrop of this setting is that there are a bunch of fintech lenders that came in, right? And so they may benefit from the lower switching costs from the portability of data. Okay, so that's open banking. And here in this paper, we'll focus more on the fintech lenders. Those unambiguously from the theory, they're predicted to be better off. The theory has some predictions on the incumbent banks, which I think would be interesting to test if possible. Some of these banks are publicly listed, so you might get some data, but I'm not sure how rich the data will be for India. But the bigger picture is this, that welfare can actually come down if the fintech becomes too empowered, if they become a monopoly, okay? And actually, there is some evidence that alleviates this concern that Shashwat showed towards the end, whereby you actually saw that if you had a higher internal credit rating score by the fintech, they actually start lowering their interest rates. Okay, this would not be true if they could collect information rents, right? So that means there may be enough competition among the fintechs. Overall, you would expect to see industry profits go up. Those are all testable implications. Okay, and yeah, a small comment on thinking about privacy, although that does not seem to be the concern. I mean, it's the government doesn't seem to be too concerned about that, which I don't know, which if it were me, I'll be even more concerned after hearing that. But I know that's not the goal of this paper. So what's the backdrop? When we talk about the digital financial infrastructure, there are a couple things. And I think June and Bernie both raised this point in the presentation. UPI is not just one thing. It's not just open banking by itself. It's like this whole thing called the India stack. Okay, so I'll show you a flow chart that Shashwat didn't get to. So I'll try to help you, explain that part in the time that I have. So we have stuff related to GovTech, which is about digital IDs. So that's like in Singapore, you have your SingPass, your document warehousing, right? All your tax records. In India, it's called Aadhaar. And then you have your public payment rails, right? That is allowing the transfer between banks. And so UPI, the Unified Payment Interface, when we talk about the payment rails, that's going to enable the banks to actually be moving funds around across each other quicker. And then we have open banking, which I view it not through the lens of government technology, but government rulemaking, right, on the industry. So you just have to force the industries to say you're allowed to export your data. So in Singapore, if you don't quickly download your bank statements after 6 months, per statement, you have to pay $5 to access. If the government woke up one day and just said, look, you should be able to get your data anytime you want for free, right? Then they'll just switch, right? They'll just do it. And then you have, of course, payment networks, which is, one example is Visa coming out of a consortium of different banks, right? Starting with Bank of America and so on. Unified QR system, right? That is also government rulemaking on the industry. And then you have the framework for open banking, which is more, big picture, more related to things related to data governance, data contracting. Are you allowed to sell your data and so on? And then you have the lender specific stuff, which are the apps, portals, right? And that's like the Google interface. So of course, when you interact, you kind of need components from all three. So when we're talking about the India stack, or what is UPI, that's my first comment. I also want to think about, is it worth thinking about open banking without digital IDs? Okay, and the reason I bring this up is because 2 months ago, I was at Cornell in this financial consumer and financial regulation conference, and Bob Hunt from the Philly Fed, who does work in the Financial Consumer Institute, was talking about how in America, just from a political perspective, there's very strong pushback to create digital IDs. And if you don't have digital IDs, it becomes quite difficult to do data portability digitally, right? And so you use things like state level driver's license, right? Which is kind of an ID that may not be harmonized, or a passport not everyone has, or social security number, which not everyone may have as well. So, this notion of a digital ID versus open banking, I think is worth thinking about, especially in Europe, I think, where, they're not going to harmonize Germany and French's digital ID system, but they might want data portability, right? So is it worth disentangling? I think that's more like a philosophical question, but it will affect the way that the paper's presented, right? Because here, of course, the India stack includes all of these components, right? So I take this from an organized indiastack.org, which they produced a very nice flowchart where you have your account aggregator. I understand that to be something like Google. And then you have the information. You might have all your insurance, tax forms, banks, and the users of that. And so you can actually consent, right? They will pull in the data to the aggregator, and the ones who want to use the data, you can consent to share the data as well. And we have a version of that they're testing in Singapore. And so actually, the digital ID component really is about like a lot of information. That's the framework that they have. I think in the setting we're looking at here in this paper, some of the functionality may still not all be there. I think it's worth discussing, right? When did these functionalities come? Because in the data, from the couple plots we saw, a lot of the fintech lending, I think, really exploded in 2019, at least in rupee terms. Okay, so comment number one is, I think it's worth discussing more on what is the UPI, and that helps us frame also to the literature and then better identify, I think, the incremental contribution. I feel like a challenge in publishing something like this is that when you have multiple mechanisms at once, reviewers may want you to try to speak to specific things, right? Because different countries may only have some of these components. I don't think it detracts from the importance of the paper, but, academia is a weird place. So, first question is, can we disentangle the components of digital payments, the creation of the financial history from digital IDs, right? Which is just, I now can verify who I am. versus the data portability component. And I understand it's extremely difficult to tease this out. You actually may have some chance with the network-based measures. If the digital IDs and the digitization overall, even without the transactions or portability, just lowers operating costs for companies, right? Because we just reduce paper, you would actually see a broad-based increase in loans, right? Because it's just reducing the cost of initiating any kind of financial transaction or interaction. And then you would expect it to be driven by the extensive margin borrower as well. So I'm a little concerned that, just a digitization, digital transformation push without these other components in there may already be generating part of these results. The intensive margin of bank borrowers, I like the results there because it actually shows most of the increase goes to prime in rupee terms. And we'll talk a bit more about that. And, a lot of the pitch, especially like from table 2 onwards, and even in the talk today, we switch from the data portability component to creating financial history, which is the alternative data stuff, which is more related to, digital footprints and so on, right? To help you do credit scoring, which is, I think, a slightly different mechanism than the open banking component. And, Pulak has a couple papers on this where it's talking about fintech lending, as well as cashless payments, the impact on additional consumption and so on. And so, maybe we can try to parcel some of these things out to narrow the scope a little bit, but then it will give you better identification of the mechanism. Because I think the current framework and the current presentation of the results, while I think very important from a human society perspective, the external validity for other settings, I think maybe is somewhat limited because we're not quite sure what is causing this. Right. And Bill Gates' whole pitch is you should take this whole India stack and just make it every country stack. Right. And maybe that is the appropriate policy, prescription. So I'm not sure, but I think that's worth thinking about. Second comment in terms of welfare, there are comments in the paper. It just may be a writing thing. Things like, low barrier to entry may result in excessive competition. It's not obvious what excessive competition means. There's no citation, no model. So it's worth discussing, like, what do we mean by excess competition in this space? Is the market breaking down or what, and, the effects are estimated in terms of rupees, but presented in terms of relative percentages, which to me raises the question, why not just do it in log levels where you can get that, right away, or Poisson. And if you look at the point estimates in the dollar amounts or the rupee amounts, the effects, for subprime are, there and driven by fintech, and new to credit are bigger than the subprime and driven by fintech. So this is where the invisible primes or hidden primes will be, right? So this is people with no history, but they're actually good credit risk if you give them the opportunity. But the rupee effects are like way dominated by the prime, which, given the current presentation, I know you've updated, so I'm going after an old version, but in rupee terms, you're gonna, it actually undermines some of the statements you're making. So if you do it everything relative, I think that just makes it, everything more coherent. So I think it's worth checking the profitability of the banks relating back to the framework. I think that's going to matter a lot for, talking about welfare implications. And I think we really want to make the point like pretty strongly that, unlike some of the literature, this is not a game of cream skimming, right? This is about the extensive margin expansion and finding the good borrowers. The loan performance and default rates are kind of weird. I would have expected that the default rates would have gone up a little bit. Because, why not have if you're really extending a lot more loans with a lower interest rate and your data is better, you can maybe, why don't the fintechs push, right, the lending a bit further to you have slightly higher default rates on average, but still be positive NPV. So the framework, I think, should be viewed from the perspective of, is this positive NPV, right, from the fintech lender as well. My concern, of course, is when it's grouped together with digital payments and the existing literature in digital payments is those who adopt digital payments effectively have like this boost in economic activity, right? And so, everything is just better off. And I know we try to control it in terms of regions, but I'm concerned that the exposure variable at the pin code level still is capturing, right, like sub-region heterogeneity. The geo, I think, experiment is very good. If I were you, I would have packaged the geo identification as like the main thing, following the broad summary stats. To me, that's like the strongest part, because the bias, as you said, works against you. The last comment, and I'll be fairly quick. I hate to do this, but I've had reviewers do it to me, so I'm passing on the trauma. Where we sent in a paper with a chart like this, and the reviewer just drew a straight line, okay, from beginning to the end, and just showed that it goes through all of the it goes through all of the confidence intervals and asks, is this a shock? Because if you look at this, I don't think it's visually different than what you expect from a trend. And I think part of the problem in this identification, the specification, is when you do it in rupee levels, all the natural growth rates will still be in there. So you're not pulling out the growth rates actually with the district time fixed effects, because they're multiplicative rather than additive, right? And so if you just did the log, I think you would clear that up dramatically. But of course, looking at this, I'm going to be concerned if you do the log, you also see nothing. You could do some things like looking at high exposures versus low rather than splitting on median. I think there are tricks there. Or just, try to more directly just instrument, right, for UPI, ex post UPI adoption, accounting for the network effect, and just run this as an IV. And so, yeah, I'll go through this fairly quickly. I think if you take the network effect more seriously, like Sean's work, you could actually, there are these network models, right, where you adopt the payment system because of some linear combination of your peer effects. That actually very nicely gives you a framework for an IV to use, which I think would be very reasonable. Because the concern now is these exposures based on pre-period early adoption may be correlated with these unobserved outcomes. And so, yeah, I think, we'll do things in the logs. A lot of the tables you showed effectively have that intuition, right, when you scale the coefficients with the pre-average and so on. But yeah, so I don't know. I don't like coming after identification, but that's the world we have to live in. So let me conclude here. I think it's a very good and comprehensive study on the pattern around the introduction of the India stack. Which exact component of the India stack is driving this, I think, is still a bit of a challenge, which may may limit some of the external validity. But at the end of the day, like this whole Indian experiment, I think is phenomenal. And so I don't want to let, identification concerns detract from the importance of this paper. And I think anyone who is interested in economic development or fintech both should be going through this. I mean, this has been an amazing experiment. Yeah, thank you.
Thanks, Ben. Let's open the floor for discussions. We have about 20 minutes. Or maybe Shashwat or Manju, if you want to respond to Ben's discussant, that would be fine as well.
Yeah, so first I'd like to thank Ben for, clearly spending a lot of time on the paper and for some very thoughtful comments. I thought, the point that you made that fintechs are not just doing crimp skimming, but it's beyond, is actually a very good point, and maybe something we need to highlight a little bit more in the paper. On identification, we have thought about it a good deal. And the point of, could it be other economic observables? Now, Shashwat didn't, he ran out of time in his presentation, but we do two tests that actually look at this very closely. So one is, taking adjacent pin codes and trying to look at the differences. And the second, which I think is the stronger test, is doing the grids and actually having, fixed effects within that. So it's like we could be across the street, you're high and I low exposure, and, and we still see these differences. So, the thing is, the results are very strong. It's almost no matter what you throw at it, it's there. Like, as you said, figure one just captures it. It's so
Right.
strong. And so, our feeling is it's there sort of no matter what. And, we're getting to have a longer and longer paper, and we're throwing more and more robustness checks on it. But that is our feeling. The other sort of bigger picture issue, right? And that is we're looking at a very important sort of social experiment, if you will, in India. We are having an open banking, but you have this digital, sort of publicly financed digital infrastructure. And obviously, everything we're seeing is a combination of all that, right? And I think the first sort of question, as I said, Bill Gates would ask is, does this matter? Does it work? And I think that's where we are. And said, not only does it matter, not only does it work, it's like massive if you just look at the effects. And I think the way I view it is it's a starting point for policy discussions for other countries where there may or may not be the appetite to go the whole 9 yards the way India has, but you want to do some parts of it. Well, first, does the whole 9 yards work? And that's what we're sort of identifying, if you will, and going at. And then it's a question of, I think the next, well, if I take pieces of it, how much further will I go? And clearly that is the debate that other countries, are where, like UK, it's the 9 largest banks only doing the sharing. USA, we don't even have a discussion. In Singapore, it's very different. And so I think this is going to be the subject of a lot of debate in a lot of countries and hopefully in a lot of papers going forward. Thanks.
That actually makes me reminds me of, there's this literature thinking about expanding bank account access to poor people, right? And this was pushed in America as well. And then once they did that, they actually did not see those people's lives dramatically change. So the policy question became, what happened, and actually the results that I estimate, if you look at like some of the stuff on JDY times post, that loads really strongly. So it almost feels like, right, that it's unlocking the potential of the bank accounts, right, with the digital infrastructure.
Absolutely. So I view it as a superpower, right? Because this question of how do you bank the unbanked is not just an India question. I mean, I'm in a senior, at the FDIC where I worked for 2 years and I continue to be an advisor there. They do a biannual survey of the unbanked and the underbanked. And, the numbers vary by time, but you're looking at unbanked in the range of 5-6%, underbanked in the range of 16%. Like these are massive numbers, right? And the question is, why are they unbanked? So we sort of know by now, thanks to them and, and the survey. But the fact is, just giving a bank account, it's a maybe a necessary but not sufficient condition. Take the bank account, combine the digital payments and open banking where the customer owns the data. This is what is critical, right? So other people and I'm going to count myself as one of them. We take data from a single fintech, right? And then we say, okay, digital footprint matters or whatever. And I think this is important. You have to start the literature with whatever you have. And, now this paper, in contrast, we have data from the whole of India, right? And so you think about in the US, people get credit, TransUnion or credit bureau data, a 5% sample, and they write these papers. We have 100%, right? So first, just in terms of what's there, and we're not talking of a single fintech, right? So even the payment, the sort of papers and cashless payments, you're looking at one fintech and saying, okay, I have data on this, could I do this? Same thing, my digital footprint paper, looking at, you have this access and you can do alternate sort of credit scoring, does it matter? But the transportability, this is what open banking does, right? Where the customer owns the data. So it doesn't matter whether, whether you're Amazon or you're Apple and you have my data and you choose to use it or not, I can apply it to 10 other people, right? And that is the power of open banking. And I think that's really what this experiment sort of shows up. That's where the power is.
I like the paper, really along the same line. I want to thank the authors and the discussions and Manju's wonderful input in this discussion. I want to make some suggestions. Now, first, why I like the paper, because in this region of the world, the unbanked population is large. And the paper offer the insights and the right experiments and the right way to really serve the unbanked. From that, I want to ask the following. At the very beginning, I asked the question, what is being open? So the openness here is really the data you own, and then you allow the fintech companies to take it. Then I think there's something very important that we may want to explore further. The first question I have is, what is the economic impact of this financial inclusion that previously the unbanked and now they are covered? I wonder, and you have regional specific data, I wonder if you are able to take an extra step to show the regional economic impact, because we want to serve the unbanked for a purpose. And I think you have the data and the paper, maybe a sequel is poised to really deliver that result. The second thing is about the change in the behavior. Fintech excel in data analytics in this situation, I think. Then what about the traditional banks? When we look at what is being opened, now there are multiple forms of what is being opened. What you have is transaction data. All these are very tangible data. But in the running of banking and so on and so forth, we have to think about there exists another set of information which is very individual specific. And it is almost like I would call it tacit information. With the fintech company excelling in the big data analytics, what do you think the banks will do? They lose their rent in the past, but the rent in the past is not really I have the account, but really I have the tacit information that allow me to draw from my borrower the rent. That is the paper. So in this current situation, what would it mean for the banks? And actually, it may not be a bad idea for the banks to now push further into that kind of credit granting. So you can think of a market two segments of market. One kind of market, small loan based on tangible released objective data. The other one is based on tacit information, and you have to work hard to do it, and it will be individual specific, and those kind of loan will be larger, etc., etc. And I also think that your paper is ready and poised to write another sequel, which is about the change of this on the bank's behavior. And if you can show this, then maybe you can have a more complete picture of the impact of this kind of open bank. Well, I think I've used that enough airtime. Some other people.
So I think you're absolutely right. Right, there's a bigger so what we focus in this paper on the payment, it's like the equivalent of what in the US is the ACH, right? That's what you're getting here. Now, what I have done in my other papers, right? So in my RFS digital footprint papers, we talk of alternate credit scoring mechanisms by virtue of, how you access the website and other things. And in other papers that I've done using banking data in Germany, there we find, your past transactions, relationships, and all of these matter in giving loans, right? And so clearly, when you think about banking, there's a lot that's going on, right? And I think it is important to be clear, what we are focusing on this paper is one aspect, an important aspect, but one aspect, which is the digital payments. So that's the equivalent of an ACH. It's not the whole bank account, right? It's the payment history, if you will, and the power of that when you have sort of open banking. Now, that doesn't mean banks don't have an advantage in other areas. It doesn't mean fintechs might not have an advantage in alternate scoring mechanisms. And I've written on both of those, right? So I think you're right. There's a much sort of larger picture. And this is really looking at the digital sort of payment thing. So Shashwat, did you have anything you wanted to add, either in response to the discussion or otherwise?
I mean, not much, because you kind of covered everything, and Ben did make very thoughtful comments. So as Professor Puri said, we have thought a lot about identification, and we've tried a lot of things, and it remains quite robust. We also have these triple differences, and in the revised version, we have this appendix where we divide the sample into, let's say, high JDY and low JDY samples, and then we compare high exposure versus low exposure within the subsamples. And we do find that this expansion of credit to new to credit segment is primarily coming from high JDY sample. So it is not just high exposure areas continuing to show some trend that was going on. Your comment on log levels is well taken. We have done it. We can include it in the paper. The one concern with log was that there were a lot of zeros, so we can, as a robustness, include poison. Again, on default rates, we do find that default rates on an average are going up, especially for the new to credit segment. We don't find a differential effect across the treated and control regions.
Yeah.
And so, just one last point. So, and again, as Professor Puri said, a lot of things are combined together: digital identity, digital payment, and digital portability. Now, payments and portability, we don't want to disentangle because we think that these two go together. But ID started in 2010. So once this bank accounts were open for this unbanked, those IDs were still relevant. But we do see even in aggregate data that this new to credit loans really picks up post UPI launch, which gives us some confidence that this is not really ID, but digital payments and the data portability driving it. Thank you, Bernie, for your comments as well. I don't have much to add. All of those are well taken.
Manju and Shashwat, interesting paper. I cannot help but bring up the parallel to fintech platforms in China. I find it was kind of intriguing that it was left out of the literature by both the presentation and the discussion. In China, there is a development of these digital payments, online credit, both consumer credit and commercial credit by small business, and also the introduction of digital payments, the QR code scanning, and offline usage of the digital payments, how they are linked to, as a way of financial fintech adoption and as a way of financial inclusion. So I'm curious, why is there any difference between these two type of settings? I mean, why is that literature somehow was left out of that, out of your kind of?
No, sorry. Okay, so I think we do have some references, but let me tell you what I think is the main difference. And I think the main difference is open banking, right? And that is in India, who owns the data? It's the customer who owns the data. And at the push of a button, so it's not just if Alipay wants to, use the data and make you a loan. At the push of a button, I can share my data with anyone. It can be Bank of America, it can be Rocket Mortgage, it can be a fintech, it can be a bank. So I am not at the mercy of whoever I'm doing the transaction to. And I think this is just a big, big difference, right? And that is open banking and the fact that the customer owns the data, right? And as you said, there are other papers, including my own, looking at digital footprint and how do these things matter. And and I think there's been some excellent work on it. I think what is new in our paper is, we're not looking at a single fintech or a single platform which has the data and then may or may not give you a loan. We're looking at the whole of India where the customer has access to their own data at the push of a button, can share it with any bank or fintech, and asking, now does this lead to a change in credit access? And both, not just from an academic, but from a policy point of view, I think that is huge.
Okay, I agree. Just to follow up, do you think the takeoff in this fintech credit, the plot we saw, is the main driver is really the sharing of the data, or the customers are actually on the platform? Because both can be the driver behind that takeoff in credit amount of loans made on fintech platforms, right? It could be that banks now have more information about your transaction. They are more willing to make the loan. But it could also be that customers now on the platform, they are doing digital payments. They are more familiar with the whole system, and they're more likely to apply for loans. So can you disentangle these two channels? Because your argument, the open banking argument, really builds on this information sharing.
So one of the things I think Shashwat showed very briefly in the presentation was the landing page, right, of the app. And you could see ads pop up like apply for an instant loan of 8 lakhs, right? And so now, so if I'm making payments, let's say through Google Pay, these ads pop up and it says, okay, you can apply instantaneously for a loan of up to 8 lakhs. And at the push of a button, you can ask, 10 banks or fintechs, will you provide this? And they'll come back saying yes, no, and the interest rate, etc. Right? And so you're not just getting, so it's not just whoever you're banking with or whoever you're making the transactions to. It's you can share the data with anyone, right? And so that just shows how easy it is. I just push, and now I have it with all of these. So again, we don't have data. We have data for the whole of India, but this is at the pin code level, not at the individual level. So we don't know exactly who is banking, who is transacting with who. But, the fact that you find this and you find such big differences between the high and the low exposure area and the zillion robustness checks we do, that sort of leads us to believe it really is, open banking and the digital payments that is making all the difference.
So just to add briefly, Google in this case doesn't really make loans. Google partners with other fintechs and banks. And many of the fintechs don't really have their own payment apps. So they are really partnering with UPI players to be able to access this data. And then they do need to access it via API, but obviously given consumer consent.
Okay, thanks. So if there are no further questions, I guess that concludes our today's webinar. Thanks for the presenters and the discussants. And Bernie also asked me to make the following announcement. For the next webinar, it's going to be in 4 days. No, in about a month, on November 21st. The paper is titled Large Language Models and the Return Prediction in China. And the presenter is going to be Xiaoyan. The presenter is going to be Ling Tan, and the discussant, Bernie, who is going to be the discussant? And has not.
Discussion is Yinan Su from Johns Hopkins.
Oh, okay, great. All right. Thank you very much for attending today's webinar. See you next time.
Thank you, everybody.
Thank
you.
you.
I really enjoyed this. Thanks for your contribution.